Many traders focus on indicators and signals, but overlook one of the most important elements, where price is likely to react. Understanding supply and demand zones gives you a clear view of where buying and selling pressure may return, and that insight can make all the difference. In this video, you'll learn how to identify valid supply and demand zones, 4 key price patterns that often precede strong market reactions, how to confirm a zone using price action and market structure, what liquidity sweeps are and how to recognize them, and how to use Fibonacci retracement levels to refine your zones and improve your trade planning. Whether you're refining your strategy or building a solid foundation, this video is designed to help you analyze the market with greater confidence and clarity. Before we jump in, don't forget to like the video, subscribe to the channel, and turn on the bell so you never miss an upload. A supply zone is an area on the chart where sellers step in with enough force to halt the upward movement of price. It typically forms after a strong rally when major players like banks or institutions start offloading their positions to secure profits. This surge in selling pressure causes the market to reverse and drop from that level. On the flip side, a demand zone is where buyers show up in strength, preventing the price from falling further. It usually appears after a downward move, signaling that smart money is entering the market, pushing the price back up. Both zones mark key areas where the market is likely to react, offering valuable clues for potential trade setups. Supply and demand zones don't just appear randomly, they form in recognizable patterns. And if you want to trade like smart money, you need to master these 4 key formations. Let's start with one of the most powerful, the drop-based rally. This is not just a bullish reversal, it's a signature move by institutions. Here's how it plays out. First, the price drops. It looks like a sell-off, but in reality, it's often a trap, a move designed to shake out retail traders and trigger stop losses. Then comes the base, a quiet consolidation where price moves sideways. But this stillness, it's not indecision, it's preparation. This is where smart money starts accumulating, loading up without attracting attention. And then comes the rally, an aggressive move upward as institutions unleash their full buying power. This isn't just a random spike, it's the result of a calculated plan. Push the price down, accumulate at the best levels, then let the market fly. Let's look at a real chart. Notice the drop? It's not just noise, it's a deliberate liquidity grab, engineered to flush out weak hands. The base that follows? That's the hidden battleground. Smart money is building positions while retail traders are confused or scared. They might even see fake signals, thinking price will break lower. But then, the rally hits, and it's fast, because the heavy players are in full control now. This entire structure forms a clear demand zone, a zone where smart money left their fingerprint. And as a trader, you know exactly what that means. When price revisits this zone, there's a high probability it explodes upward again. Why? Because institutions rarely buy everything at once. They scale in, and when price comes back, they have pending limit orders waiting. Meanwhile, retail traders rush in late, placing stop losses too close, giving smart money another chance to sweep that liquidity before launching price once more. That's the exact move we look for as traders, a precise, repeatable edge. But this is just the beginning, only a glimpse of the full strategy. Stick around because in the next section, I'll show you exactly how to trade these zones for consistent, high probability entries. Now, let's flip the script and break down the rally base drop, a textbook bearish reversal pattern. The market climbs, forms a pause, the base, and then plunges. But this isn't random. It's a strategic move, and that base, it's where smart money starts quietly selling into strength. This zone becomes a supply zone, a powerful reference point where institutional footprints are left behind. When price comes back to this level, institutions already have their sell orders stacked. And retail traders? They often place stop losses just above that zone, the perfect target for a liquidity sweep. Once those stops are cleared, the market drops sharply. That's the kind of move scalpers live for. Take a look at this real chart. First, we see a strong rally, likely fueled by institutional buyers, but then price stalls and forms a base. That's the handoff. Smart money begins unloading their positions quietly. The result? A sudden drop as selling pressure takes over. But here's the trader's edge. We don't chase the drop. We wait for the retest. When price pulls back to the supply zone, that's our moment. The institutions often step back in, and we follow, entering with precision and exiting quickly before the market fully reacts. That's how you stay ahead. Next, let's break down the rally base rally. A powerful bullish continuation pattern. Unlike a reversal, this one signals that buyers aren't done yet. Here's how it works. Price surges upward, then pauses to form a base. But this base isn't weakness. It's a breather, a calm before the next upward push. This pause in price action is where institutions are quietly reloading. They're not exiting, they're preparing for the next move. And when the market breaks out of the base with another rally, it confirms one thing. Buyers are still in control. Now look at this chart. A textbook rally base rally. The market takes off with a strong bullish move, likely fueled by smart money. Then comes the base, a tight consolidation zone. To retail traders, it might seem like the rally is stalling or losing steam, but in reality, this is accumulation, a quiet buildup of buying pressure by those who move the market. This is where trading psychology plays a key role. While the average trader hesitates or expects a reversal, the professionals are positioning themselves for the next leg up. And once price breaks above the base, it's the confirmation we've been waiting for. Momentum is back and smart money is leading the charge. As traders, we don't chase the breakout. We wait for the retest. When price pulls back to the base, that's our entry. A clean, low-risk setup. We get in, ride the momentum, and get out fast, locking in profits before the crowd catches on. Finally, let's break down the drop-base drop, a powerful bearish continuation pattern. It starts with a clear downward move, showing that sellers are firmly in control. Then, price pauses and forms a base. But don't be fooled. This isn't a reversal. It's a setup, a moment where institutions are quietly preparing for the next wave of selling. Once that preparation is done, the market drops again, sharply. This continuation move confirms that the selling pressure hasn't eased. That base in the middle? It becomes a supply zone, a key level where smart money unloaded some of their positions and may be planning to re-enter. Let's zoom in on a real chart. First, you'll spot the strong drop, a clean, impulsive move downward. Then comes the base, a moment of calm that hides what's really happening. Institutions are stacking up their sell orders here, but they do it quietly, without disrupting the market.